because again, it's all about those first impressions, and that will determine how they may perceive the digital offering of these providers. Using an example here in the UK, your likes of your Monzo, your Revolut, those neobanks, the challenger banks here, they're all mobile first. That's as expected, and I think as a result, a lot of consumers will instinctively perceive their digital offering as being more superior, more sophisticated, because it starts on a mobile. You know that you'll be able to complete that task via the mobile because there's no other channels.
As we pass the midway point of 2025, we're witnessing a fascinating convergence. Social media has become the new town square for financial decisions. Mobile apps are overtaking traditional financial channels, and after years of digital self-service, consumers are seeking human financial advice at levels not seen since the financial crisis. Meanwhile, alternative financial options are experiencing an unexpected renaissance, and artificial intelligence stands at a critical inflection point between promise and practice. Welcome to today's episode, where we're going to be diving deep into the seismic shifts that are reshaping the financial services landscape, even in mid-2025, and looking a little bit towards 2026. I'm joined by Luke Allchin, Director of Research at RFI Global, who brings us groundbreaking insights into the latest MacroMonitor data tracking of over 130 million households. Luke's research will reveal that 2026 won't just be another year of incremental changes. It will be a year that separates digital natives from digital laggards, and where trust becomes the ultimate currency. So let's explore what financial institutions need to know to thrive in this rapidly evolving landscape. So Luke, tell us a little bit about yourself, and also introduce, for those people who may not be familiar, what RFI Global really is.
Excellent. Thanks, Jim, and hi, everyone. I'm Luke Allchin. I'm Research Director at RFI Global. Been at the company and been working within market research now for over 10 years. RFI Global itself is a global market research agency provider. We partner with banks, financial institutions, investment agencies, really trying to help provide the voice of the customer in the research, trying to understand what is the behaviours of consumers and households, what drives their choices, what drives their preferences, and really trying to understand around some of the changes in sentiment as well, looking at some of the historical trends and trying to look more towards the future as to where we see the market going. Over the years, I've had multiple roles and positions within RFI Global, some of which have been more global, but more recently I've been focused on the North America region, both Canada and the US, and really excited to be talking a little bit more today about our study, the MacroMonitor study in the US, which represents 130 million US households, but also touch upon some other trends we're seeing more globally as well.
It's interesting, in the banking world, it used to be that year after year after year, not a whole lot changed, but we're at midway point of 2025, and you wrote an interesting post on LinkedIn, and your research shows that actually there's so many trends, both on the consumer side and the back end, at the banking side, that have really changed the marketplace even at mid-year point. So what consumer trends stand out to you as the most significant in the banking and financial services area, and what has changed from what you maybe thought was going to happen in 2025, and what's going to happen as we go towards 2026?
Yeah, well, I think your introduction was spot on in the sense that we're at a inflection point. I think the rate at which things are changing in the digital banking space is accelerating. Obviously, I'm sure we'll touch upon AI at some point during today's conversation, like how can you avoid a subject as important as that. But I think one of the most, not surprising, but most important trends that we're seeing in the data right now is this general openness of the sentiment towards trying new financial services, new technologies. There are a few factors that may be behind it in terms of what's driving people to become more open. It's possible just the general growth of comfort in, digital, digital providers. But I think also there's some cost considerations as well. I think right now, not just in the US, but globally, a number of households may be struggling a little bit financially. There's a lot of new challenges they face. And as a result, there's this growing openness to sort of shop around. And I think as well, looking for those low-cost options, which has in turn opened up their mind to trying new providers, new services, new products, new technologies. So I think that's one of the factors there that's going to be driving or helping to drive and accelerate some of the digital transitions that we're beginning to see right now.
It's interesting. The technology that's available, the digital products are being introduced, the options in the marketplace, and, you reference in your research, the social media aspect of it really is changing all the dynamics as far as how people shop, what they're shopping for, what their expectations are. And I think to another point, and you bring it up in your research, the divergence of consumers as to the way they want to access financial services. Yes, there's a lot of people that are going full digital, but there's still a lot of people that go, you know what? Not so fast, my friend. I want to go about it a little differently. It's interesting. According to your research, social media has jumped from 28% to 44% usage for financial information in just 2 years. That's an astronomical jump. What's driving this dramatic shift, and how should traditional financial institutions respond to Facebook, YouTube, and even TikTok becoming primary research channels?
Yeah, I say the trend itself, long term, we have seen there's been quite a steady and consistent growth of consumers beginning to use social media as a way of accessing financial information and product information. But yeah, the spike, the jump you just referenced in terms of going up to 44% is significant. Like, it's really changed in terms of what we've seen the years prior to that. In terms of what it means, I think, as you mentioned, it's the way in which consumers want to be able to access information is changing. People are more likely now than they have in the past to see the internet has been a good tool for sourcing this information. They're more likely to go online before they'll go into branch to sort of try to access that information and try and self-serve. And then in terms of, on the flip side as well, you've got influencers, or influencers they sometimes like to call themselves as well. I think is really, they're the ones who are able to engage with consumers on a different sort of level, on a more personal level than maybe what some of the financial institutions are currently doing on these social media platforms. And again, about the social proofing of it as well, in terms of recommendations from their peers, is also become more and more important in terms of driving considerations. And naturally, the way in which social media works is that whole sharing of information with your peers. So it's just the right sort of platform in which to be able to not just reach your customers, but then reach their network, which all could be potential future customers as well. I think it's about getting the right sort of balance of providing the informative and information, but also ensuring that there's some sort of level of personality to it as well. I think the age of sort of a faceless financial institution is beginning to fade. I think there needs to be a slight step into social media and realise that it's a growing platform. And I think financial institutions need to ensure that they have a voice there. Because realistically, while it may not be the only place they're seeking information, in a lot of cases it's where that decision-making process begins. And if you don't have a voice on social media, then there's a chance you might not be part of that decision-making process, part of that conversation to even begin with.
Yeah, and you can't do it just like every other financial institution. It used to be that, okay, we're on Twitter, we're responding to people when they have a question or they have an issue and they want to get into, direct communication directly through the channel. It's interesting too because of social media, because of technology, the competitive set has changed. It used to be your competitive set was pretty much the financial institutions that had branches in your area. Well, now, you have the ability to search interest rates across the entire country or across the globe. You can look at financial services that are offered overseas and start to use those financial services. It really changed the entire data set and competitive set for financial institutions. but the opportunities are immense for consumers that really want to dig into, what do I want to do next? What do I want to invest in, or how do I want my services to be used? And we even question at times now more than ever, is the checking account still the primary financial relationship? I know with my son, he has never written a check in his life, I don't believe, because he doesn't have a check in his checking account. He uses, mobile banking and Venmo and other services. And it may be the credit relationships that are the most important, because he will immediately pay off those credit cards, but the credit relationship is the one he uses as much, along with Venmo. It's interesting because mobile has totally overtaken desktop for banking, and it's about to do the same for investing. What does that mean for firms that are prioritizing the web-first experience in the world of, and I'm going to use investing in the general sense, but in the way of putting your money away?
Yeah, I think the trend that we're seeing is not new. It's been happening steadily over time. In terms of mobile banking overtaking sort of the web-based platform, that initially in our data occurred back in 2020, and realistically, I think it's going to be in 2026 when we see the same happen in that investing space as well. But that being said, it's not completely, or not yet at least, not completely cannibalizing the web-based platform. We are seeing a growing number of consumers using both. But that being said, the proportion of households and consumers in the US who are using the web-based platforms is slowly decreasing. Obviously, the rate at which mobile is increasing is greater than the web-based platforms decreasing, but the direction which they're going in is clear. And it might not be 2026, but we were talking in the next sort of 5 or 10 years that it will get to a point where the web-based platforms won't even be serving the majority of consumers in the market. Everyone will be moving more and more towards mobile.
Yeah.
And there is this growing expectation as well that you should be able to conduct all of your banking tasks via the app. So it's clear in terms of where we're going. It's still got a little bit of way to go before it will solely be app based. But yeah, the direction that we're moving in is very, very clear. So consumers want to be going towards apps, and as consumers age and more of these sort of the tech native Gen Zs and Gen Alphas age, and the Gen Alphas become part of the banking population. Think about them in terms of some of these younger individuals have never owned a laptop. They don't own a PC. It's all done via the mobile phone. And as the population continues to age and these people enter in those different life stages, it's just going to be reinforcing that and driving that forward in terms of that transition towards solely mobile. It's no longer going to be a case of juggling the two in terms of doing some things online, some things on mobile. I think in a lot of cases consumers will prefer to do it on mobile, but sometimes they only deviate towards the desktop in instances where they are struggling on the mobile app.
It's interesting though. We've had a couple people on the show recently that have made a case for the fact that I can't really tell that much difference between my bank and competitors' banks on a mobile app. That basically financial institutions in some weird way have taken what they used to do in the branch, which was not that much differentiation between products, and done the same thing with the mobile app, where if you took some of the colors away, you took the logo away, you'd be hard pressed to see any difference between bank A, B, and C with regard to the experience on a mobile app. As a researcher, what do you see as maybe being the way that financial institutions will be able to differentiate themselves on a mobile platform that maybe is not even being done today?
Yeah. Well, I think you're right in terms of there being, in some cases, little differentiation between the apps provided by different competitors and different institutions. I think we've got to the stage now where it's a hygiene factor. When you join a new bank, there's expectations there that the app will be sufficient, that you'll be able to conduct most of your everyday banking tasks via it with relative ease. I think one of the main things, though, in terms of how to differentiate is it comes down to the onboarding and how the account opening begins. So because again, it's all about those first impressions, and that will determine how they may perceive the digital offering of these providers. Using an example here in the UK, your likes of your Monzo, your Revolut, those neobanks, the challenger banks here, they're all mobile first. That's as expected, and I think as a result, a lot of consumers will instinctively perceive their digital offering as being more superior, more sophisticated, because it starts on a mobile. You know that you'll be able to complete that task via the mobile because there's no other channels. But another example is, say, Barclays here in the UK. I think out of a lot of the other sort of incumbent banks here, Barclays is one of the only ones who are mobile or app first in the application onboarding process.
Yep.
Before you can apply for a current account, a checking account here in the UK with Barclays, you first have to download the app. Then you sort of set up. Then you basically do the application while doing the digital onboarding. Whereas in a lot of the other incumbent banks, you'll be directed to the web browser. You do your application, and then you have to wait a couple of days for your debit card to come through the post. And in a separate letter, you'll get like a little code in which to then do the digital onboarding. And before you know it, it's been 3 or 4 days until you can access the account, access the debit card, begin using the bank account. Whereas in the likes of Barclays and some of the other sort of neo-challenger banks as well, you're already set up on the app. And in some cases as well, they may offer a virtual debit card until your physical one arrives in the post, and you can load it onto your mobile wallet.
Right.
And from day one, you're able to now use the account. Whereas in some of the traditional forms, in terms of the onboarding, is separate to the account opening. It's just causing more delays. And I think if you're especially some of younger consumers who have not yet experienced the offerings or digital offerings from many providers before then, their first impression of that will be, this is mobile first. That's more. It makes more digital sense in terms of those providers and what they're offering, and therefore that will determine how they perceive the complete digital offering, if that sort of makes sense. I think it's the first impressions is what's really, really important, because in a lot of cases, especially in markets where the rate of consumers switching bank account providers is relatively low, they don't have much to go on. Their experience may be limited to 1 or 2 providers. So it's all about how they are perceiving it without having yet experienced it. And I think if they know that you're going to be, you download the app first and everything's done in the app before you've opened the account, then there's just this expectation that, they're more committed to that mobile app and being, mobile first. And I think that's what's really going to be a differentiating factor.
Yeah, it gets down to friction. It also gets down to the financial institutions that are doing things the way they always did, even when they have a mobile platform. Yeah, they continue to put all the friction they would have otherwise. We talk about it often. It's interesting. You talk about the challenger banks. Your data shows that 31% of new banking relationships are now with challenger banks. And are we witnessing the beginning of the end of traditional banking, or is there a path for incumbents to actually still compete?
I think it could be the beginning. I think the stats you've pulled out there is based around new account openings. So, people, US households, consumers who've opened up a primary bank account in the last 24 months, 31% of those was with one of these digital-only challenger banks. And again, it hasn't completely, shifted the whole market yet, but It shows how strong that trend is, and that it shows the direction of where the market is going. Why is it that a third of these consumers are going towards these digital-only players? And again, you've got the likes of Chime, for example, being one of the primary providers there. There aren't too many about. When you think about how many, the sheer number of financial institutions in the US, these digital-only providers make up a very, very small number in comparison. But why are they able to attract such a large number of these, recent account openings, recent switches? And again, I think it is just showing that there is a change in preference. And, I think there's still a place in the market right now for some of that face-to-face interaction, whether it's in branch or not. But I think, again, there is a growing comfort to trying now and conducting these tasks online before then having to go into branch. I think during the lockdown periods, during the COVID, during 2022 and then early into 2021, what we saw in our data was there was a big shift away from face-to-face physical interaction because they were off limits.
Yep.
And I remember at the time, a number of our clients were asking, are these trends going to, what's going to happen when the branches open up again? Are these trends will it remain? And I think initially what we saw is that once lockdown and restrictions were lifted, consumers did start going back to branch, but only for a short period of time. I think there's a lot of these consumers who had previously, they've always gone to branch to do a certain task, and they were quite, adamant that they didn't want to change how they've done things. They were quite stubborn in that sense. But once they were forced to do it online, and then once they were given options to go back into branch, that's when they had a more of a comparison now, and they I think soon realised that actually, I've now learned how to do it online. I've learned to do it on my mobile, and I do prefer to do it that way. But yeah, it's just it's a growing company. It's not just being driven by those younger consumers as well. I think older consumers have also had plenty of time now to begin, gaining exposure to the digital platforms and become more confident. And again, some of these neobanks as well. We're not just talking about brands who've been around for a couple of years. Some of these neobanks have been around for 10 plus years now. So they've had enough time now to be established in the market, and they've become brands that, even amongst the older consumers, but just generally in the market, consumers are aware of this brand. They're seeing the advertising and marketing either physically as they walk around, in stores, or references on, if you're on the underground or on the train, but also online. The fact that more people are doing and researching online means that, whereas in the past it was all about that sort of physical marketing was like a key in terms of driving awareness and consideration, which then meant, played more in favour of some of the bigger institutions that had already had a branch network, an ATM network. Those logos were seen on the high streets. Whereas now, because people are going online and they're going on social media, it's leveled the playing field in the sense that, you don't need to have this big branch network or this ATM network or physical or adverts in magazines or newspapers to be able to get the exposure. I think just as a result, people have become more familiar, more comfort, and as a result, become more trusting towards some of these neobanks.
Yeah, I think what's interesting too is it's not just the new banking relationships. We've done some research. We do it informally and formally, and we find that a lot of traditional financial institutions kind of lull themselves into a false sense of confidence where they're saying, well, we haven't really lost that much relationships. We haven't had that big of an attrition. Well, the reality is, or people are opening new accounts without closing their old ones. So you get the sense that the people haven't left when actually their share of relevance has really changed dramatically in that they're using other organizations that are digital first or digital only, alternative financial providers, or even let's say a big financial institution while they have maybe a community banking relationship still. That attrition is palatable. And I think the fact that everything's digital now, you don't have to close your existing accounts. You can just shrink it. And you can get into a bad situation of thinking you have X number of relationships, when the reality is it's a much smaller proportion because they're not doing the transactions there. One of the things in your research you showed is that the demand for personal financial advice is the highest since the 2008 financial crisis, which is astounding to me that it's been that long. How should financial institutions scale advice, which is more face-to-face, while still keeping it personal?
Yeah, so I think we're likely to talk about it a little bit more as well in a moment, but sort of AI, I think, will be a key part of this as well. There is, I don't mean in terms of like robo-advisors or, in terms of, AI chatbots being the sole provider of these advisory services or offering them their guidance. But I can see it as being a way of, offering some sort of hybrid solution where the AI or chatbot, it can be the start of that conversation. It can pull together some information, create a bit of a summary, So that when you then have that conversation with the advisor, there's already some, way in which that information is being provided to the advisor is more digestible, and it can be a more efficient service being offered in terms of, to maximize the value of that conversation they're then having with that advisor. I think in a lot of cases when it comes to AI, it's not going to be a solely AI driven product or services. It's about introducing in such a way that will be able to offer a benefit to the existing service. I think that's how I see it shaping up. So again, I think right now there's not a high level of trust or even understanding to some degree when it comes to AI. So there still needs a bit of time to try to introduce people to it. And then as for the advisory services, I think there is a clear opportunity there to try to utilize AI and chatbots in part of that conversation. Again, it could also be a way in which to try to offer a more sort of a bit more of a cost saving or be more competitively priced. Because as I said, earlier on, consumers and households in the US have become more cost conscious. Right now, they're looking at ways in which to minimize their spending. And so even though advisory services have gone up, it's in reflection to the challenges they're facing. So they need this advice, they need this guidance. But at the same time, they're also looking to try and find ways of reducing their costs. So it's possible, I think, sort of some hybrid service is really what's going to sort of play out and win in, at least in the short term, before we may see wider adoption of AI.
It's interesting because you have technology, you have the emergence of AI, as we mentioned, and your research showed that 84% of households still have concerns about AI in finance, primarily around privacy and accuracy. Is 2026 too optimistic for mainstream AI adoption in beyond basic chatbots, where you may have some agentic AI or use of AI to actually drive personalized financial relationships? Or are we at the tipping point right now where it really will come as early as 2026?
I do think 2026 will be the start of something. As mentioned, I still think that it might be 2026 will be where we see sort of these hybrid services, trying to integrate within some of the existing services. I think we still have quite some way to go before we see it become mainstream and seeing like wide adoption of it in the market. Our data shows that around a third of consumers believe they have a fairly good understanding of what AI is, but there is still a large proportion of consumers who are still a bit unsure, not fully engaged with AI just yet. They may not really see how it will be able to be used in financial services. There is openness and interest there in terms of possibly trying some of these solutions. But as I said, in terms of the 84% you mentioned, in terms of consumers having some sort of form of concern, it's a large number. There's quite a big hurdle, I think, for institutions to get over before we start seeing, consumers ready to adopt, some of these solutions and these services. So it's all going to come down to trust.
Yeah, it's going to be interesting too. Yeah, it's going to be interesting too, because as consumers start to use AI tools more and more, and they learn a little bit more about how to prompt correctly, how to ask questions about finances using AI, they're probably going to dip their toes in the water a lot more individually on their own to get a sense that, okay, I can probably depend on this even being better with my own traditional financial institutions. It'll be interesting to see how those rank overall going along together, where, we were talking about it before the podcast with my team about, as good as AI can get, sometimes that can be scary in and of itself, where it can be sometimes almost too good. And it's going to depend on the consumer overall adoption and utilization of AI for basic things. I'm using it for helping to plan for a vacation, and I find it to be extraordinarily helpful in saving me time as opposed to pouring through books on what to do when you're in X, Y, or Z location. But as people get more and more familiar and have more assurance that the answer will come back fairly well, then I think they'll start allowing their financial institutions to use it and provide recommendations. I think it's also going to be interesting to see if financial institutions will trust it enough to provide answers based on it. What can be done and what financial institutions will do, because they're in such a risk avoidance mode as opposed to risk moderation mode, where they don't want any bad answers, and that's not realistic. It's not realistic when you have personal financial relationship managers out there doing it. It's going to be interesting to see how it goes, and I think you're right that I think we're going to see a tipping point in the very near future. It's just a matter of how deep do we get. I think that's going to be interesting. And you mentioned that trust and transparency is going to be critical for AI. How can banks address that trust and transparency and really address data privacy and decision-making accuracy while still innovating quickly?
Yeah. I think to some extent, I think the point you made about personal use of AI is going to go some way there. I think even if you're unsure about whether or not you want to use AI when it comes to your banking and managing your money, I can understand why some people may be a bit hesitant there. I think their usage in their sort of personal life, where it's planning a trip or looking up a recipe, like these sort of things, I think is the starting point. If you start beginning to be able to trust the information that's provided there and begin to understand that actually AI it's reliable, it can be depended on, I think that then gives way for them to become more open to using it in regards to their finances. That being said, in terms of being able to try and ensure transparency and try to reassure customers that the information they're getting from these AI services are going to be accurate, I think it all comes down to making sure that the information behind, say, the algorithm or the AI decision-making process, it needs to be readily available. I think if a consumer before you can trust something, you need to be able to understand what's going on in the background. I think that's going to be really, really key. And I think what they're going to want to try and avoid is, consumers having to go down a bit of a rabbit hole to find that information. If you're having to dig around, click on multiple links and you're struggling to find the information you're after, that's where I think you can begin to lose a bit of trust among the consumers. They start wondering, how is it so hard to find this information? Why is it not as transparent as what it should be? Are they hiding anything from me? But I think just making sure that the information is readily available, should the consumer start, want to try and be reassured. It's an opportunity basically to reassure the consumers that, there is limitations. Yes, same with everything, but just having it very clear and transparent to consumers, so then they can make an informed decision about to what extent they will trust the information they're being provided. If the information is not available, then you can't put a gauge as to where you would trust the information that's being provided. I think you need to have the information to be first to be able to make a judgment yourself. So I think that's really what's going to be really key here in terms of just making sure that it's easy accessible.
Yeah.
And that's clear and easy to understand as well. Using layman terms, don't go into too much depth, but ensure that there's enough information there for consumers to build up an understanding as to what's actually going on in the background.
Yeah. We've just touched the top layer of all the things that are going on and all the things that still can go on this year and beyond. Looking at all the trends that you're looking at, because you're continually at your organization, you're continually doing research on the consumer and the financial institution industry overall, looking at all the trends that are interrelated in many ways. Looking at all the trends that you see, some of which we maybe haven't even touched yet in our conversation, what's the single biggest mistake that financial institutions could make in their planning for next year? And what's the greatest opportunity that they might miss?
Yeah. Maybe starting with the opportunity, I think one of the clearest opportunities from me is about ensuring you have a strong voice on social media. The rate at which that's growing and changing, it's rapid. And I think 2026 will be much the same. It's really becoming a key battleground, I think, in terms of acquisition, recommendation, NPS. You need to make sure you've got a voice there and, being part of those conversations and those early decision-making processes. I think, I think we've passed the point at which financial institutions can be a faceless organisation. I think there's a need for there to have some sort of like personality, something that consumers can engage with and interact with on social media. Again, I think a really, really good example of this is in the UK, you've got like Monzo, and you've got the Monzo. I'm thinking about when I'm just on LinkedIn, for example. You have the Monzo account there is, they're making posts, quite informative information, quite professional. But then you've got this other account called Greg at Monzo. So I imagine the guy, who knows, the guy may not even be called Greg, or the person might not be called Greg, but it's Greg at Monzo. It's like this separate account, which is part of Monzo, and it's much more funny, quirky. It still provides some useful information, but there's also some jokes being thrown at there as well. And it's sort of become a face, a personality within the Monzo's organisation. And I think you see people interact with that more so than the other, the more core professional Monzo account. But see, that's where I think where we're going to start seeing things going. There needs to be a personality there, something for consumers to engage with and speak with. Whereas otherwise, if it remains too formal, the only sort of times you get people interact with those posts is to vent some frustrations, or say, "Oh, my account, I've locked out my account. This is how that's happened," and then you just get a whole load of like negative comments in terms of a chance to voice a frustration. Whereas, if there is that sort of a little bit of playful fun and interaction there as well, there's positive comments there as well. It's building that sort of community and also visibility as well. Then, the more someone will be engaged with a post, the more it'll be, pushed out to other consumers, other individuals. I think the one thing that can't be, it shouldn't be overlooked, is the fact that when it comes to apps, it's not all just about delivering more and more functionalities and more features. I think you've got to ensure as well that the core part of that app still works well, and against the whole idea of it feeling personal to the individual. It's got to feel connected in terms of whichever channel you're interacting via. There's got to be some sort of omni-channel experience there. It's got to feel seamless, and I think it's got to feel live as well. When you're speaking to someone, you want to feel like you're being listened to. I think all in all, it gives an idea that it's delivering an app which feels more relevant to the consumer and the user who's having it, an experience that will align with their needs and like the stage at which they are in life. I think that's really, really important to get right. It's not just about delivering the latest features or this new innovation, but it's about ensuring that it's building that personal feeling, because as we move away from some of the physical channels, it's still important that there is that sense there with banking. You still want to build a relationship. So I think those are the two things I see as being quite important, I think, in terms of moving into 2026 and the years to come.
I think it's interesting because the technology, the social media, the way that people buy, the way that people evaluate, the differentiators are moving so fast that I think we're going to see consumers expecting more. The bar's going to be raised higher very quickly, because we're seeing it everywhere else. It's not just in financial services. The way we do travel, the way we do hospitality, the way we shop for groceries, the way we go out to dinner, the way we order dinner. Everything we do in our lives now is so interrelated to the technology that's available that we know as a consumer at the most basic level what's possible. Our children are being brought up in a world that they've never seen anything other than computers and mobile devices. So, while we've been able to, sometimes not be as up to date in the financial services world, they're no longer going to give us a pass and say, yeah, but that's banking. The reality, banking is going to be expected to do more because people expect, they rely on their financial services to get them over the hump. The definition of resilience that used to be all around risk and privacy and security now is much broader. If you're only resilient if you can be there for your consumer when they want you. And I think it's important as we look towards 2026 and beyond to be ready for that. That's why we do this podcast, is that we continually try to keep people up to date on what's going on out there, what you need to do immediately, what you can maybe take a pass on for a little while. But, we're doing a mid-year review of the plans and everything we thought was going to happen in 2025, because things have changed since the beginning of 2025. And I think, for those of you who listen and you want to hear more about the future of retail banking and financial services, be sure to watch my presentation I did recently in Abu Dhabi, where I discussed the future of banking in a world of AI. And also even go back to evergreen podcasts that got into what we were saying even a couple of years ago, because I think if you look at that, you can see where we were going and where we actually are today. And I think you'll see that there's a big difference between what we thought we'd be doing and where we are. And I think we've advanced beyond a lot of those.